Hey, welcome back to Harvesting Income. RMAX ETF. This is a fresh approach to real estate income. Basically, using covered calls on REITs to generate income. This is a unique concept which has come into play, and one of the funds that is doing this is called RMAX, which is Hamilton REITs Yield Maximizer ETF. In this video, we're going to discover how RMAX is actually employing covered call strategy on REITs. In the previous video, we talked about Mortgage Investment Corporation, and there I mentioned that there are some funds which are doing covered call on REITs. There's an idea about that, and this is exactly what I was discussing about. And let's see how it works. Before that, quick disclaimer: any information that we discuss here is only for entertainment and education purposes, not financial advice or not investment advice. And with that, let's move to the next area. Okay, Hamilton REIT Yield Maximizer is ETF, that is RMAX, that's the ticker symbol. So this has a strategy that is designed to deliver attractive monthly income using covered call strategy. Secondly, they provide equal weight exposure to the real estate investment trust or REITs in Canada and the US. Lastly, they mitigate or reduce the risk and volatility. So these are the three key objectives of the fund. That is what the fund is trying to achieve. Basically, they try to deliver attractive monthly income and provide exposure to REITs in US, Canada, and mitigate risk and reduce volatility. So if you're looking for steady amount of income and exposure to REITs in North America, and also some kind of a fund or a strategy that helps mitigate risk, this is a good option that you can look at. Okay, the ticker symbol is RMAX. Price is 16.55. The fund was started June 2024. So not much of history. Like it's about 6 months. Sorry, 8 months or 9 months so far. Net assets of 77 million. Expense ratio 0.65. And this is actually managed by Hamilton ETFs, which is a fairly reputed fund. And they have some of the star funds which are diversified covered call ETFs. So they are not new to the covered call space. They have been in the space for a long time, and they have a huge asset base. And this fund is fairly new, but they have experience in this area, so that actually is a positive factor when it comes to choosing funds. And by the way, this is not a recommendation. I'm just giving you the basic information. Okay, let's look at the holdings. Sorry. So holdings, I have taken just the top 10 here. And if you can see on the left side, we have the names: Welltower, Equinix, Simon, Digital Realty Trust, Prologix, Realty Income Corp. Some names are pretty familiar, like Smart Centers, Ryocan, probably Equinix, Digital Realty, Simon. So some names are familiar, some names probably I'm not familiar with them, but I did some research on them just to get an idea of what is in the portfolio. But I just looked at the top 10 so that we can get a quick idea about how it works. The Well Tower is basically a healthcare infrastructure REIT. It's not a regular REIT. And Equinix and Digital Realty, the second one and the fourth one, okay, EQIX and DLR, they are data centers basically. These are not regular real estate buildings, they are data centers. They provide a data center facility on lease to companies. And Simon Property and Smart Centers, Ryocan, these are all the retail or shopping mall focused funds. And Prologix is a little unique. They are into warehouse or logistics. So you have the mix of these real estate investment trusts, which are fairly unique in terms of their approach, basically, because these are new segments within the real estate industry. These are not the traditional real estate companies, little newer companies. Probably Simon would be a traditional real estate player, but the others are fairly new players. Probably they have newer approaches, newer technologies, newer way of doing business. So that's the stock selection that or REIT selection that the fund has made here, which I like this is a good approach here, rather than picking just the old REITs. Of course, they have other types of REITs which are traditional as well, including industrial REITs, residential REITs, and so on. Geographically, if you look at it, it's basically 53% is US and 46% Canada. So majority of the portfolio is from US and 47% Canada. And if you look at the sectoral breakdown, subsectors within the REITs, 35% is retail REITs, 14.7 industrial. So these two are the major ones. Telecom towers 9.2, data centers 11.6, multifamily residential close to 9%, and self storage about 9.7%. There's a mix of different sectors, so it's not concentrated in one sector. There is a little higher concentration on the retail side, but other than that, it's pretty well diversified. And I looked at the dividend yields, like looked at the dividends for the last, you know, 7 months, like since the fund has been launched, and February to, you know, all the way to back to August 2024. So it's about 7 months. Like every month they have been paying about 14 cents dividend, and it could be 14 point something, and total comes to about 95 cents. And when I do the math, like I estimate that in 12 months they'll make about 1.63. This is again a speculative math, like an estimate, not the real number. um, so based on the price of 16.83, like in February 2025, I get an estimated yield of 9.7% just on the dividends. Like this is just the dividend yield, and which is excellent because it's pretty high compared to index REITs. And we don't have any benchmark to compare this. But if you compare this with any real estate investment trust probably give you 5%, 6%. Some index REITs provide you lower yields. This is comparable to index REITs because this is a basket of REITs, not a single REIT. So I think this is pretty attractive given the lower risk and the higher yield that you are getting. And in terms of price appreciation, when the fund started, it was about 1597, and currently February 7th, it's about 1683. The appreciation is about 5.4%. And if I convert it to annualized number, it's about 8.6%. So that's 8.6. Again, this is past performance and estimate. This may not continue in future. Based on the numbers that we have, this beats inflation, this beats REIT index ETFs. There could be some exceptions or some funds which may beat this fund, but generally speaking, the fund is able to beat most of its peers. Okay, let's look at the total returns. I looked at the last 1 year performance, like total returns. It comes to 18.3%. 18% in 1 year is exceptional. Again, this could be just the favorable market conditions in the initial period that the fund has been launched, and dividend is about 9.7, and capital appreciation 8.6. It's 18. So this may not sustain in the future. It could be probably less. But when you compare it with the inflation 1.8% and other real estate investment trusts like REIT index ETFs, XRE, ZRE, XRE is giving minus 3.73, ZRE is giving 2.99%, 3% roughly. These are Canadian REIT index ETFs, which are quite popular. And based on this, you can see that the other REITs are not giving you much returns, total returns I'm talking about. So in total returns, it's beating the REITs. And there's a chart below as well, which shows the lower returns for these 2 months. And this data is coming from Seeking Alpha, which provides the total return data. Uh, when this fund is beating these index ETFs, then it's a pretty attractive alternative. And since you're getting a good amount of yield, you can also reinvest back into the fund or reinvest elsewhere in other stocks or other funds. So that seems to be a good option and pretty attractive in my view. And what makes the REMAX unique? REMAX basically writes at the money calls, and the calls are returned close to prevailing market levels, which means they are able to generate higher income, the scope for higher income. And since they use a dynamic covered call writing strategy, they write up to 30% of the overall portfolio. So the entire portfolio is not used for the covered call writing, only 30% is used, which means the third point, the balance 70% of the portfolio is open for unlimited upside or higher capital appreciation. So for the 70% of the portfolio, the upside is not capped. And the other thing to keep in mind is this fund has exposure to segments such as data centers, e-commerce, warehouses, and so on, which makes it very unique compared to other REITs. So that's makes these 4 points make the RMAX little unique compared to other funds. Okay, pros and cons of RMAX. The pros are higher income potential than traditional REITs, scope for higher capital appreciation, and this suits passive income investing style because you can buy and hold for a longer period of time. And during volatile and interest rate sensitive periods, RMAX help reduce volatility. So it helps you in terms of providing you the shock absorber or a kind of a buffer. It cannot completely wipe off the loss, it cannot eliminate all losses, but it helps you cushion some of the losses. And an important point, equal weight in the portfolio helps to maintain the diversification and you benefit from diversification. Some REITs are concentrated in terms of certain REITs, and the some REIT index ETFs have higher percentage of holding in some bigger REITs, and that can be too concentrated. But this one is equal weight and it's fairly diversified. And this includes modern segments within the real estate, which helps you to benefit from modern trends such as data centers, warehouse, and so on. Those are the pros, but the interesting thing that people are looking for is what are the cons, what are the issues with the RMAX. Any fund will have certain drawbacks, and similarly this one has a shorter history and it's launched June 2024. Not much of track record, but the fund has a good track record in terms of call strategies, but only time will tell whether it's able to you know be successful over a long period of time. And dividends are very variable, like it seems to be consistent so far, but it can vary, can go up and down. That's something to keep in mind. And the portfolio has data centers and newer segments, and these segments may or may not perform well. So that's another con. And what I recommend is like for small exposure, like about 5 to 10% of the portfolio. That's the max you can go. You don't have to go full on into these funds. You can go up to maximum 10% if you're comfortable. Lesser, it is better. And then as you get more comfortable, you can add holdings. So that's the summary of the pros and cons of this ETF. And now the question is, who is it actually suitable for? So basically, this is suitable for someone who is interested to have a small exposure to real estate or real estate like industries and segments. And the good thing is you get a strong dividend yield potential and than the traditional REITs or REIT ETFs. And for someone who looking for balance of income and capital appreciation, this is a good fund. And there are some unique features as explained before, like they have a new segment of property types and newer options available. So that's something to look at. So these are the four factors that make it unique. And if you are looking for these features, and some of them were discussed in the previous pages, then you can consider investing in this ETF. And by the way, I'm not endorsing or promoting this. This is just my point of view, and you can take a small exposure if you like it. Okay, if you want to invest in this, there are two ways of doing this, and it's up to you whichever way you want to choose. First is direct, and second would be indirect. And direct is very simple. You buy the RMAX ETF and add it to your portfolio. You can buy from your brokerage or your trading account. And indirect is basically there are bigger funds, HYLD and HDIV, which are part of the Hamilton ETFs, and these funds have exposure to RMAX. HYLD has 2% exposure to RMAX, and HDIV has about 3% exposure to RMAX. And again, these funds are also diversified funds. So within that, you have the RMAX. Like, so these are some other options you can consider to indirectly invest in RMAX if you like one of these ones. So these are different options you can look at, whichever suits you. And as we come to the end of the video, I hope you like this presentation on REITs, and especially covered call on REITs using a new ETF known as the RMAX. And if you liked what you're watching, please subscribe to the channel. And if you have any questions, any comments, anything you want to know more, please feel free to drop your comments below. And thanks a lot. Happy investing.